In today's Lunchtime Stock Club webinar, I'm going to talk about the market and how it's performed in 2017. I'm going to look at, make some prognostications about 2018 as well, point out some high points of the economy and the market, what we can look out for the year ahead, and then we'll finally talk about a small company stock of interest to growth stock investors. So as we ended 2018, here is where we stood. These are the three market segments that I like to track. The purple line on top is the Morgan Stanley Europe Australasia Far East Index, the EFA, and you can see that was up almost 22% for the year. So the EFA index represents large cap stocks outside of the US in the developed world. And those companies have been on a tear. They had been down since 2012 and lagging the US markets and pulled ahead last year and had a very solid year. This speaks to the importance of diversifying a portfolio globally. You can capture a lot of that performance in the S&P 500, since more than half of revenues and earnings in the S&P 500 are coming from outside the US. But you can also look to diversify a little bit further with some developed economies around the world using that EFA index. The light blue line right underneath that is the S&P 500, up 18.4% or thereabouts for the full year. So a pretty solid year for the S&P 500. And then down below is the green line. That is the Russell 2000 Small Cap Index, up 13.5%. 13.5% would be a terrific rate of return in just about any market, but it lagged the S&P 500 last year by a considerable margin. And that's not uncommon during late stages of a bull market when any investor can buy just about any large cap stock and it goes up in price. There's no reason to look at lesser known names, about the smaller companies, the smaller players. You can get achieve a reasonable return using large company stocks, and so many investors prefer those brand names over the up-and-comers, and so I think that's holding back small caps just a little bit. But that will not be the case forever, and we continue to encourage you to diversify your portfolio with both small and large company stocks, and I think we may see some bigger gains in the next year from the small company segment. Now, a large part of the performance of the S&P 500 is due to continuing low interest rates, which are making equities just much more popular than putting your money into the bond market and collecting relatively meager yields, or a savings account where you're getting hardly any interest. This is continuing to support that PE ratio of the S&P 500, which on an estimated trailing 12-month basis was at 26.35 at the end of last week. And so that continues to be a relatively elevated figure. It's climbing up a little bit. That red line indicates where that figure would have been, so you can compare it to the middle of the 1990s bull market and go back in time to 1870 and see that this is indeed a very high PE ratio. The market crash in 2007 there has been lopped off a little bit on the high side, so that's definitely what I would consider an outlier, where that PE is reaching 50, 60 there. In the 2000s, you can see that PE ratio reached in excess of 40 at the right before the bubble burst. And so we're not in that kind of bubble territory. And when you look at the S&P 500 PE ratio on a projected basis, we're still in very reasonable territory, and that's because of this next graph, which is a chart of the S&P 500 earnings in that same period. And you can see we're very nearly at an all-time high of earnings per share for the S&P 500 companies in aggregate. So as profits are continue to rise, as corporate earnings continue to grow, then that supports those high valuations of the stock market. There's a lot of investor sentiment going on. There's a lot of and a lot of factors that are influencing the relatively high level of the market. But I think many pundits and market watchers are of the mindset that this is not necessarily indicative of a bubble, and that there is a likelihood that the market will continue to run up in 2018. And I feel badly for investors who 1, 2, 3, 4 years ago started pulling money out of the equities market, going to safety, going to cash, going to bonds, going to wherever they thought they were going to get a better return and protect their portfolios, because they've missed quite a massive run-up in the overall market. So I think the bottom line is there's still room to grow for the U.S. Equities market, but of course we are always looking at opportunities on a company basis, and so we're going to continue to find those companies that have the characteristics that we like to see and invest in those. And that's the advantage of being a stock picker, is that you can pick and choose, and you can be a little more defensive if you so choose. You can be a little more aggressive if you so choose. And you can shift your portfolio slightly, but remembering always that over the long term, the stock market is always bullish, and every bear market has always ended. So with that, let's take a look now at some thoughts about where things might be headed in 2018. It's a very popular topic. At the end of the year and the start of the new year, everybody gets their crystal balls out and decides to figure out where the market's going to go and where the economy is headed in the coming 12 months. And so I've done a little bit of research and looked at some of the data, and so I have some thoughts about where we stand right now and the likelihood of negative events happening in the economy, or any of the various components of the economy, as well as to the market itself. In a nutshell, when we look at the economy, and we'll take a look at these in a little more detail, the GDP has been relatively stable in the U.S. There is some weakness to it, but the Fed seems to think that we're well within a reasonable growth range. Unemployment remains low and continues to decline. Interest rates are going up, and that is generally perceived as a good thing. The housing market is also performing quite well, and inflation is probably going to tick up a little bit. And again, not necessarily a bad thing, but something that you should be aware of. So let's just take a look at the GDP. In 2018, as of the third quarter, GDP growth was 3.2%, and that's the highest since the first quarter of 2015. So we see some upturns there. The graph here is going back to the 1950s, and what's really interesting to me about this graph is that you can see, as you look at this period here into the 80s, a whole lot more volatility in GDP growth. We'd have big gains, and then those would drop off in the next year. We go into lost territory. When we look at the second half, so from the mid-80s on, you can see that this has been a much more restrained growth pattern of GDP, and much less volatile. So in part, I think this is due to the transition of the U.S. economy from industrial production to services and technology, and so I think that has helped to sort of normalize the GDP growth. And you can see, we have not really exceeded 5% growth on a quarterly basis in going back 15 years at this point. Ticked over slightly a year or two ago. We have seen those declines when we had our market correction and financial market meltdown back in 2007, 2008, and the resulting recession. So pretty pretty big slowdown there, but a fairly rapid recovery there. The trade deficit is still a concern, I think. We still import much more than we export, although services have been increasing. The export of services around the world has been increasing as a portion of the GDP. So I think that continues to speak to some of the strengths of American business. So nominal GDP growth for 2018 probably working its way up to 4%, and that would be well within the range of recent history and in what I think the Fed considers a sustainable rate of growth. When we look at the unemployment, here's a graph of unemployment for the last decade. That cross-hatched area on the left is the latest recession. So you can see, of course, during recession that this period right here, the recession, you can see that unemployment climbed up, peaking at 10% here in 2009. And then just steadily declining after that. So unemployment has been continues to be low. It reached a 17-year low in November at 4.1%, and I think that that's a good thing, and that's just a long-term trend that's in place as American business has recovered from the last recession. But the issue that I have with unemployment is that we're reaching that point below which we're not going to see big gains anymore. Everyone who wants a job at this point, not everyone, of course, but most people who want work can find it, and this is going to cause problems. There are regions in the country, of course, where unemployment is weaker and or stronger, but the problem is that companies that need to hire workers are going to find fewer and fewer candidates. And so if you have work that needs to be done and you can't find people to do it, what do? You have to increase wages. And so I think there's a potential we're going to start to see as unemployment really kind of bottoms out this year, how much that might hamper corporate earnings if companies really are having trouble finding workers. And it's probably going to be a lot of workers on the low end. Walmart takes a lot of flack for not providing a lot of benefits, but they are providing work for a whole lot of people at the low end of the scale. There has been some talk of tax reform getting passed on to workers, and I'll talk more about that later. My feeling is that that's not happening, and in fact, we've seen cases already where companies have announced massive layoffs as soon as the tax reform bill hit. They're laying off workers, so the money they're going to be saving in corporate income taxes is going to go to shareholders. It's going to go to share buybacks. It's going to go to dividends. It's going to go to management. It's not going to support increases in wages across the line for workers in the field. So the problem with unemployment reaching down to new levels and wages increasing is that we could see contributing to some of the inflation expectations, and we'll talk more about that in just a minute. So generally, though, of course, it's great when we've got low unemployment. We can still see that low employment figure continue to decline. Let's see it closer to 3%, and that will be then we're reaching that point at which the economy just simply can't offer any more employment, even to those people who really want it. When we look next at the interest rates, the Fed in their most recent meeting was very clear that they're continuing to follow the course that they have been following. It looks like the Fed will raise interest rates 3 times in 2018, and that'll take the fund rate to 2 to 2.25%. So they're just stepping it up bit by bit, quarter by quarter, 0.25% at a time. The Fed is also continuing to wind down quantitative easing. This is their program of buying bonds, Treasury government bonds in the market, and helping prop up some of those markets. Other global central banks have been doing the same, and so we'll see what the impact of that is, because we're really in uncharted territory with the level of buying that has been happened, how those assets reach the market and what they do to the bond market. Kind of a open-ended question. Looks like treasuries could reach the mid 3 to 4%. They've been as high as 3 something in the last year. They're at 2.1% right now. So there, would be some concerns as it reaches up to 4%. But again, there's nothing here that's going to cause stock investors to get very excited. Interest rates at 2.25, treasuries even at 4% yields. Just nothing there that's going to, I think, drive a large-scale departure from the equities market. And so I think the Fed is very careful about continuing to be very cautious, and there is definitely some concern in the most recent Fed meeting notes that some of the participants in the meeting had about contributing to inflation by increasing the cost of capital. So that could delay some of these rate increases in 2018. Housing starts and housing overall has been very robust. I think a lot of people got turned off from the housing business following the meltdown in 2007, 2008. The graph down below shows you housing starts in the U.S. And over the long term, and you can see them reaching a new peak at around 2007, right here, obviously on the graph, reaching a peak before precipitously plummeting. But since that time, they've been working their way back up. And I like, I'm not a chartist, but I just like that the rate of growth is from the 1990s for 15 years there, it's about 15 years, has been just about the same as we've been seeing recently. So I think it's a very measured state of growth. I do cover a couple of housing companies in our small cap informer. Some of the top 25 home builders in the U.S., Century Communities and LGI Homes. LGI has just been getting hammered by short sellers, and they keep making their numbers and putting the short squeeze on to perform very well. And these companies are providing entry-level homes, home prices in the $250,000 range. That's considered a starter home these days in attractive communities and desirable neighborhoods around the country. And I just don't see any end coming anytime soon for housing overall in the U.S. Housing starts were up 3.3% in November. Single-family housing starts were up 5.3%. Single-family homes are bigger profit makers than multifamily units, and so that's very strong. That's the highest level that single-family housing starts have reached since 2007, before the crash. So that's very strong. Existing home sales up 5.6%. New home sales up 17.5%. And the problem is that so many people have been buying homes recently that it's reduced the inventory. Fewer homes were completed due to weather and some other issues, and so that's is going to tighten up inventory. That's going to raise prices a little bit, but it might slow down some of the home buying as we head into the beginning of the year. But that should all end by the spring. In 2018, we're going to continue to see the housing market perform well, I think, because of continued low interest rates. I know we keep talking about interest rate increases, but really interest rates are still historically low, and that provides access to capital for a whole lot of first-time home buyers at a very attractive rates. Demographically, millennials are reaching the age now, they're aging out. They're getting into their late 20s at a time when traditionally people have been starting to think about families. They're moving out of urban areas. They're moving to the suburbs. And that's going to drive up demand for homes and the housing market over the next couple of years. And we're going to start to see even a bigger impact in 2018, I think. Supply pressures are going to drive up home prices, as I mentioned, the first half of the year. But I think there's still lots of room for housing stocks to grow. And I think that's I'll flip back to this slide and you can just look at where we were prior to the 2007-2008 crash in the collapse of the housing market. We still have a long way to go with housing starts. We're not even halfway to that point. So with the economy being strong, cost of capital being low, we just see a lot of things working in favor of the home builders as we head into 2018. Now, all of these things do kind of come together when we start talking about inflation. We've been running inflation in this country around 2%, and the Fed thinks that we could see inflation of up to 4%, and they would be fine with that. But we're still well below that level. And again, look at the history going back to before 1920, you can see the inflation rate and how it's climbed. And again, the story has been over the last 2-3 decades that inflation has been in that 0 to 4% range pretty consistently. I think a 3% average rate of inflation we've seen in the last 15 or 20 years. And so inflation has climbed. If you look at the tiny changes over here in the last couple of years, you can see inflation bottomed out during the recession and has simply been climbing back just step by step, just a little bit at a time. And I think that's healthy. Inflation means that prices go up, but it also means that people are able to afford higher prices because they're getting paid higher wages. The companies are able to, companies that make products are able to charge more for their products, so that helps them to protect their business and increase their margins a little bit. So we like to see a little bit of inflation. Inflation is not the enemy. And certainly there are some industries where inflation actually is pretty much required. Inflation is the only way that grocery stores are going to increase their profitability over the long term, for instance. Inflation is also good for oil producers and refineries in that industry because, again, they have a lot of capital sunk into their businesses, so without the ability to raise prices, they're not able to maximize their margins. So inflation, I think, will continue to climb up just a little bit, in that 2 to 3% range for sure. So what does this mean for corporate profits in 2018? Back in 2017, S&P earnings grew 10.2%. So it's kind of interesting that we see a 10.2% increase in earnings. The yield of the S&P 500 in the 4% range, roughly. 4 to 5% on a forward basis. And so you add those together, that's a 14-15% total rate of growth. And we saw the market climb up about, if we go back to our first slide, 18%, 18.5% growth. So we see a little bit of a premium over the rate of growth of earnings for the S&P 500 plus the average dividend yield. And so that's pretty strong support for 2017. Now, analysts are looking at 11% growth in 2018, and that's not counting the impact of tax reform, which some pundits, are of the mindset that that's going to further contribute to that 11% growth rate and add on top of it. But however you look at it, tax reform upside, I think, has already been built into the current valuation of the market. And so if tax reform were to be completely thrown out once again, then I think the market would take a hit. But right now, I think the upside is already built into the valuations. As I mentioned before, I think the jury's out on this the whole tax reform, tax cuts bill, and on the corporate level, how that's going to contribute to job growth or wage hikes or merely benefit shareholders. I think a lot of companies are probably going to start doing more share buybacks. That's a way of giving capital back to giving profits back to investors without implementing a dividend that they might be hard pressed to support as they go forward. We've seen that in recent years, many companies using share buybacks as a way of giving capital back to shareholders instead of paying dividends. The graph below, the long-term graph of corporate profits in the U.S. is represented by the S&P 500, and you can see those reaching back up to that all-time high that was reached back in 2015, kind of approaching that level once again. So that's, again, there doesn't seem to be any foreseeable downside, any potential problems down the road. Of course, there are always, which is not to say that it's a sure thing, but it is to say that it looks to be another strong year for the market relative to corporate earnings performance. Now, the current forward earnings yield for the S&P 500 is about 5.5%. So when you compare that to the 10-year Treasury yield of 2.4%, stocks still come out way ahead, as I've mentioned before. I think it's likely that we'll see a little bit of increase in market volatility in the year. That's been a big problem for traders and option writers in 2017, the lack of volatility in the market, share price is just not fluctuating very much on an intraday basis and not providing a lot of opportunity for traders to use strategies that have worked for them in the past. I think a 10% correction is always something that is likely to happen. What that catalyst for that might be is still not obvious, but I think impeachment of the president or resignation of the president would probably cause a short-term jolt to the market, but the market's been very resilient with respect to what's going on in Washington. So I don't think it would create an outright bear market. I think everyone's aware of the risks and the possibilities, and again, sort of built into the market as it stands right now. On the probability scale, increased tension with North Korea, potential actions there could obviously have a short-term impact on the market if things were to escalate. Other political issues around the globe, definitely some hot spots to watch out for. Domestically, everything seems to be chugging along. And it may well be that things are going so well, and that's why we should be concerned, right? If everything is looking rosy, maybe it's a case of things are a little too good looking, and we don't like that at all. There are too many bears in the market who just are people who get spooked by anomalies as they occur, and so that could drive the market. But when you look at analysts and their upside for the S&P 500 for 2018, the median is 2,600. The mean 25, 22. The range is 1,500 to 2,900. So that's on the 1,500. That's where we get some of the perma bears. The market started 2017 at 2,700. So this is not a very optimistic for those analysts, 27 of them who were forecasting the S&P 500 for 2018. Everyone is looking at by and large, looking at a flat year for the overall market. And again, that would not be a bad outcome if it gave the companies the opportunity to catch up to their valuations. If we do have 10% earnings growth and we have the stock price growth below that, then the P ratio is going to fall into a more reasonable range, and I think that would make a lot of investors a little more comfortable in where we stand right now. So that's kind of interesting where analysts on the street are looking at the market based on where we are right now heading into 2018. Now, a couple of fads and trends, cryptocurrency and cannabis. Everyone wants to know, what about this? Well, this is the Wild West. with respect to where cryptocurrency like Bitcoin and the cannabis markets are as investors. There are no clear market leaders. There's no clear picture of regulation. In fact, threats of increased regulation. These are highly speculative, and there is just massive volatility in these markets. And I don't see any way that investors like us can benefit from these markets. There are some ETFs that you could invest in, again, just as a play money, with the play money portion of your portfolio. And certainly some investors and traders are going to win big by making bets in this area, but somebody just won the Powerball for $450 million, and that doesn't mean that you can do it. It was easy for them. They just bought a ticket, but it certainly doesn't mean that you're going to have that same level of success if you buy a Powerball ticket. So keep that in mind. This is not something that I see any way into at this point, other than as just some sort of purely speculative play. There are a lot of newsletter services and pundits and websites and news reports that are just talking about cryptocurrency and cannabis over and over and over and over again. I don't think you're going to miss out. If these do continue to markets do continue to mature, there will be plenty of opportunity for you to invest in them after the dust settles a little bit and we have a little more clarity in these particular businesses. Now, I will point out that the FAANG stocks, that is Facebook, Amazon, Apple, Netflix, and Google, how they performed in 2018. This graph on the top, the five colored lines on top are the 5 FAANG stocks. The gold line at the bottom is the S&P 500. So you can see that the worst performing of the FAANG stocks was Google with a 35% return. The best performing was Amazon with a 57% return for the year, and this is with the share prices. So I think that's likely to continue to perform. I've mentioned this in the past. If I had grandkids, I might put some money aside in just these 5 companies in a portfolio and then never pay attention to it anymore. And just let it run over the long term. Maybe add Microsoft in there if you really wanted to, but I think these 5 companies are going to continue to perform. There's speculation that maybe Amazon will buy Netflix. That would be interesting. They'll have to come up with a new acronym for them. And Apple continues to be a dominant force in the market, and there's still plenty of unknowns about their staying power, what their next generation of devices are going to be. Phones get bigger, phones get smaller, tablets, Apple Watch, where the market is going to be, we don't know. They've changed the face of consumer electronics in the last 15 years. And so that innovation is likely to continue. They've got an enormous amount of cash, though. They can really could have some interesting things happening as you go forward. So I just wanted to throw that in there. We cover in the Investor Advisory Service, we actually cover Apple, Facebook, Google, and Google. We don't cover Netflix or Amazon. Amazon is really tough to study on the stock selection guide because they have not been focused on earnings growth. And so that's kind of makes it a little more difficult for us to get a bead on the right price to buy for Amazon. And again, all these stocks are probably at very high multiples relative to where they've been in the last, in their history as leaders in the bull market. But just wanted to drop this slide in there as well. All right, well, let's take a look now at a stock of interest. The stock that we're going to take a look at today is Essent Group. The ticker is ESNT. This is a specialty finance business. It was featured first in the March 2017 issue of the Small Cap Informer, and then the Investor Advisory Service picked it up in the current issue, the January 2018 issue. Essent Group offers private mortgage insurance, PMI, as well as reinsurance risk management products, primarily directed at mortgage lenders, homeowners, and real estate investors. Essent Group, here is their history. went public in 2013. We've got data going back to 2011. Since 2013, they've been consistently profitable. You can see the trend there. That's very attractive. Growth has been strong. The last 3 quarters have been strong. They reached $458 billion in sales in the last fiscal year. So this company has been performing quite well. Private mortgage insurance, if you're not familiar with private mortgage insurance, is often required by lenders for homeowners who don't have enough equity, typically 20%. If you don't have a 20% down payment, you might still qualify for a loan, but you will have to pay an additional amount for insurance that will protect the lender if you default on the loan. So it's the difference between your down payment and that 20% figure that's required. So private mortgage insurance is expanding as the real estate market continues to expand and recover. There are 6 major private mortgage insurers. A couple of those are publicly traded. And Essent is right in the middle of the pack. So it's a smaller company, but they have been growing by taking market share from much larger players. And so they've been really firing on all cylinders and being aggressive with their business plans, but conservative with their portfolio and their use of capital. And so it's just a great combination of good management and good practices for writing insurance policies. So what we like here are the profit margins for Essent. And you can see those have just grown to very strong levels over the last 5 years, or the last 4 years, 3 years of data there that you see there, and 3 years of data over 4 years. You can see that increase in profit margins. That's a level at which we probably aren't going to see a big increase. If you compare that to a couple of the major peers, Magic and Radian, you can see much higher margins there. So again, that's very strong. I'm going to flip over to Toolkit. Here's what we looked at in my Toolkit webinar last week. I'll flip back over so you can see that margin has just been steadily increasing over the last 5 years, once again. And so the question is, at 68% margin, can the company continue to increase that profit margin? And we can find that if we look at the quarterly trend analysis, the quarterly trend graph. You can see over here that in the most recent quarters, we've got 3 quarters since the last fiscal year. So these 3 quarters down here are all, this is all since the last fiscal year. And what do you know? That especially this second quarter of the year has been higher than they ended the last fiscal year. And so as well as this year has been as well. So they have been chugging along and have continued to increase profitability. We can look at the actual numbers on the quarterly trend analysis graph as we scroll down, and we look. We'll look at the over here on the right. I'll show you. So this column is what we'll pay attention to. This is the trailing 12 months. So we ended last year at 68%. Now the trailing 12 months is 70.2%. So they've actually increased that margin since the last fiscal year. And I think that's a very strong commendation for the company that they've been able to continue to maintain that growth as they go forward. So it compares quite well to peers. If we look at the SSG, I'll turn it over. Let's look at it in Toolkit. Current price as of closing price on Friday was $44. When we started covering it last March in the small cap informer, it was $35. So it's gone up quite a bit since then. It was a nice performance. The investor advisory service in the January issue, so our December price that we used was around $45. So it's actually down a little less than $1 since then. So that makes it a little more attractive in the buy range. So upside downside ratio of 3.4 to 1 and compound annual return 17%. Company doesn't pay a yield, so there's no dividend to worry about. These PE ratios pretty low on the selected low, 9.8%. Again, that's the average. It never reached that in the last 52 weeks. It never reached that 15.7 against the straight average. It was at 15.9, so I think that's still pretty reasonable. IS is looking at 14 to 16% growth. When we studied it in March in the small cap informer, we used 16% as our long-term growth rate. If we look at the most recent quarter, earnings were up 26% and sales were up 23%. So lots to like about the company. As a insurance company, you got to consider the debt, what their portfolio is. They have a small amount of debt. Their S&P rating, debt rating is triple B or triple B plus, I think. Yeah, triple B plus. And that's considered lower medium investment grade. So it is not, it's above the junk category for sure. All of these competitors are, one grade higher, one grade lower. So right in that same range. So they're right in the middle, which is pretty strong considering that this is a smaller company. We'd expect it to, have a little bit lower investment rating there. So take a look at Essent. I like the company. It's financial services, but it's also real estate. So it spans two sectors. Those are both going to be sensitive to the economy. So that's in the consumer cyclical super sector. And so keep that in mind. But I think there's plenty of room to go in real estate and housing to support continued growth of Essent Group over the long term. Well, if you have any questions, please feel free to send them in now. I've got an active travel schedule over the next couple of months. I'll be in Arizona and Orlando, in Fort Lauderdale, Cleveland, Pittsburgh, and back in Orlando for the Better Investing National Convention in May. And there may be some other events that I'll be booking as well. So if you're in any of those areas, I'll look forward at seeing you at those events as we go forward. Jay asks a question about Mednex, which seems to be struggling with declining stock price, and I don't follow the company. We'll see if we can look it up real quickly. I guess, do they cover it in the investor advisory service? Yeah, and right away, I noticed a problem. Has to do with the declining earnings here. So we've got 3 quarters where earnings have been falling. That's the the first thing I want to know is why are earnings going down? Most recent quarter earnings declined 31%. They're in the medical care. I'm not as familiar with Mednex. I think by and large, I have concerns with a lot of companies in the business of distributing medical products because of all the price cutting that's going on with insurance and the cost of care. So Mednex actually, they're doing physician services, so again, maternal care, pain care, pediatricians, obstetricians, etc. And so, yeah. And so this whole industry, I think you have to watch very carefully as Medicare reimbursements are subject to perhaps not go up as much as costs are going up. So I think it just gets tricky. But the bigger problem, I think, is this the quarterly trend. If we look at the profit margins, they're just going down and down and down, and it's not a new problem. So since the first quarter of 2016, every quarter since then, profits have been growing negatively. So profits have been going down for 1, 2, 3, 4, 5, 6, 7 quarters, and that's just a big negative for us. So that would be a big problem that I might take a look there. Al says wants to know if the 52-week high of Essent, we're back to Essent now. You can see the current price is 44, the 52-week high is 47. Are we concerned about that? I tend to not worry so much about how close a stock is to its 52-week high price. If it is, it means that it means that it's been performing well, and so there's not that I'm looking for momentum, but I'm when you find a stock where all the quarters are consistently coming in strong and they're meeting or exceeding analyst estimates, and the P ratio is reasonable, I'm gonna not worry about how close it is to the 52-week high or low price. I think in this market you get stuck often with that rule. You're gonna be holding companies that have been deeply devalued, and they're going to take longer to kind of dig themselves out of that rut. So here's a company that's not in a rut, so it's riding the top of a wave. So we're going to continue to, as long as fundamentals indicate that it's a good buy and it has possibilities. So that's my thinking on buying stocks close to their 52-week high and low. Yeah, this is what happens in an up market. We're not finding bargains in today's market that fit our approach. I mean, we're looking at stocks that are reasonable have reasonable long-term appreciation and return characteristics, but we're not seeing the kinds of bargains that you'll find at the depths of a bear market, when a stock like this might have a PE of in the single digits as a financial stock, and so that might be a better time to be looking at a company like this. All right. Stericycle. Joe asks about SRCL, Stericycle. And again, my thoughts on this, not a stock that I'm interested in buying. Sales have been going up, but earnings have been going down. Tough business, waste management. That's just, I can't imagine the kind of person who says, hey, let's go into the waste management business. It's just fraught with regulation, fraught with what are you going to, you're collecting waste. You've got to figure it out. Even with recycling, it's just, it seems to be a messy business, and no pun intended. And so I think when you're seeing this type of business, I just think there are better opportunities in the market. Even sales in the last 3 quarters there have been flat, relatively speaking, but just the earnings and the profits dropping off, I think just don't make it a very attractive business for me. It's not the kind of company that I look at. Just a couple more. NVIDIA. I know Jim Cramer's been talking about NVIDIA quite a bit. Seems to be recently, or I see him, his newsletters and things, taking a look at it. Has been a stock that's been a little more volatile, $6.9 billion now. So they've been on an uptrend, no doubt about it. Over here, 2000 on the left side, 2007, 2008, 2009, definitely more of a cyclical stock, maker of computer graphics chips, and so semiconductors, chips, etc. So those are going to fall off during a recession when companies are not expanding their computer networks, they're not buying computers, they're not hiring people, consumers are putting off buying new computers, or they're downsizing to less expensive models during recession. So you'll see that drop off there. Since then, they've been firing on all burners, and I like that. Margins have recovered last year higher than they've been in the decade, and so that's a very positive sign. Debt, I see a little debt kind of coming and going. I don't know enough about the business, but that doesn't worry me too much. So for the sake of argument, let's just fire in analysts looking at 14% growth. Let's go this way. I'm gonna just kind of pull out some of these just to kind of get a sense of yeah, 10% sales growth. I think that's probably pretty reasonable. And I'll put in 14%. Analysts, according to Morningstar, looking at 14.5%. And so just to see where that goes, and just recognize that as a semiconductor-related company, that this is going to be a lot more volatile on a cyclical basis. So yeah, so I think somewhere around, yeah. Yeah, that's not going to get us into the buy zone. Current price is $215. That's yeah. Current PE is 53. That's just this. I mean, we're expecting. This is based on an expectation of a lot higher growth. Just for the sake of argument, 20% growth. Um, that's less than it's been growing in the last 7 quarters, from what I can tell. It just seems very bold to me that we're going to go from being a $7 billion company to a $22 billion company in 5 years. On that basis, let's see. Um, yeah, it's still hard to get us into. Still very hard to get to convince me that this is a reasonable stock to buy at this point. Forecast low price $60. Yeah, there just doesn't seem to be. If we say 80% of the current price, it still doesn't. There's just no way that I'm coming close to the stock. This is just too much of a momentum stock for me. So not one that I'm taking a look at anytime soon. One more, as I said, Hanes Brands, HPI. Laura asked about that. So slow growing business, very much a commodity-based business. Sales since 2000 over the last 10 years at 4%. If we look at the post-recession, so closer to 6%, just to kind of give us but with that slowdown, and so that's kind of below my threshold. Earnings, on the other hand, have been growing pretty aggressively, much faster than sales. So let me see, kind of post-recession growth of 17%. So they've been doing some things right, I think. I'm kind of worried. I'd be concerned about the top line growth at $6 billion and growing at 5-6% a year. Analysts looks like, without going out to, so in that 9% range. So if I say 6% and 9% growth of earnings, most recent quarter sales were up 2%, earnings were up 22%. And so that 9% earnings growth rate kind of splitting the difference. That's strong. Margins have been increasing. That's good. And when we come down to kind of finding a PE ratio, current PE is 13. It'd be hard for me to imagine, the PE ratio much above 20, 24, 25 at my 9% growth rate. I'd really be looking at a high PE in the, a low double digits, so in the 13, 14% range, well below 24. Current high PE for the year was 16, which I would be fine with, and low PE of around 10. So low PE of 10, trailing 12-month earnings of $1.62, buy price up to 22, so 3.7%. So the 29% payout, a little bit higher than 29% payout, probably close to a 33% payout, giving you about a 2.8% yield right now, 2% average yield, adding to your return to get you to 15.5%. So, not the worst company. If it were, if this had a price drop, its current price is 21. It's been as high as 25, been as low as 19. Yeah, not a lot of volatility with the stock. So I would, wouldn't throw it out with throw it out altogether, but just a very slow growth might be part of a core holding that you might consider. So yeah, as Laura says, core holding for the dividend. So, and then finally, one more stock. Roy asked about OLED, Universal Display. Let me refresh my data here. They make those OLED displays for devices, and so you can see a lot of volatility in the earnings. Sales had been flattening out. We covered this in our small cap informer, but we dropped it because growth started to lag. Valuations have been through the roof. However, you can see that sales picked up finally in 2017, the first 3 quarters, and earnings have been growing as well. Excuse me. Although they were down slightly. Oh no, they were up considerably. They were they posted a 3-cent loss in the year ago quarter, ending September 30th, and they posted 28 cents this year. So should be back on track. 20% growth. Analysts looking at 30%. So, there's a lot of potential here, but it is a very volatile company. Margins have been steadily increasing. They're at the cutting edge of technology, so they're really able to extract a value there. Current price is $179. They've been as high as $192. They've been as low as $56. I'll use a high PE of 30 and a low PE of but it's not going to matter. I'll say 15 just to kind of see where it stands. There's just no way that anything is going to come up close to a buy. So if the PE of 30 and we get to $5 of earnings in 5 years, growing at 20%, that's a high price of $152. Current price is $179. So there's just no way that it's in our range. In fact, it shows up as a sell. To me, there's just a lot of downside from a PE of 87. It could be, again, if we looked at the quarters, no, we've got 4 positive quarters, but earnings and sales, just a lot of variability. If we look at the quarterly, I'll go over to the quarterly trend graph just so we can kind of look at these different it's just all over the place. That's on a quarterly basis. Even if we put it on a trailing 12-month basis, you just see just a whole lot of variability of earnings from quarter to quarter to quarter. It just shows that it's an immature company. It just hasn't really kind of settled in. And that to me is, if you were holding it now at a big profit, you might consider lightening up on it. That would be my recommendation. That it's just really hard to see where the upside is from now. All right. Well, thank you for joining me. We'll look forward to seeing you in February at our next Lunchtime Stock Club. Please feel free to email me with questions and comments. There's my email address, and let me know what you'd like to see in future sessions, what we can cover, what might be of interest to you. I'm always interested in your feedback. But I want to say Happy New Year to all of you in attendance today, and we'll look forward to a prosperous 2018 for us all.